There is one number that can determine whether debt becomes a financial trap or a tool for building wealth. And the surprising part is that it has almost nothing to do with how large the loan is. Two people can borrow the same amount of money from the same lender at the same interest rate. One can end up financially crushed, while the other can use that exact same debt to become wealthier. Same loan, same cost, completely different outcome. The difference comes down to one calculation. By the end of this video, you will know what that calculation is, and more importantly, you will be able to apply it to your own financial situation. Because debt itself is not automatically the enemy. The real problem is borrowing money without understanding what that borrowed money is producing. Think about a loan in its simplest form. You are renting someone else's money. The lender gives you capital today, you use it for a period of time, and in exchange, you pay a fee. That fee is the interest. So the real question isn't simply, how quickly can I get rid of this debt? The better question is, what is this borrowed money producing compared with what it costs me? Imagine you borrow money at 4% and use it for something that produces a 7% return. There is a 3% difference between what the money earns and what it costs. That difference is the spread. And then comes the second part of the equation, leverage. How much money are you controlling compared with the amount of your own money you have committed? Put those two ideas together and you get the number that matters most, your return on your own capital. This completely changes how you look at debt. Someone struggling financially may see a loan and immediately think, how do I pay this off? A sophisticated investor asks a different question. What is the spread, and how much capital can I control with my own money? That same question appears in almost every strategy we are about to examine. Some of these strategies are practical for ordinary people. Others require substantial assets, experience, or access to capital. But understanding the entire system matters, because the small versions are easier to recognize once you understand how the large versions work. Start with something surprisingly simple, trade credit. Imagine you run a business selling pens. The traditional approach would be to use your own money to purchase inventory, wait for it to arrive, and then hope customers buy it quickly enough to recover your cash. But businesses often don't have to work that way. A supplier might allow you to receive the inventory today and pay 30, 60, or even 90 days later. Now something important has happened. You are controlling inventory before you have actually paid for it. If you sell the products during that period, the customer's money arrives before your supplier's bill is due. You collect the revenue, pay the supplier, and keep your margin. The supplier effectively financed the inventory. And this is why business owners care so much about terms. They don't always need more of their own money. Sometimes they need more time between receiving something and having to pay for it. The same principle can appear on a much smaller scale. A customer deposit can fund part of a project before you purchase materials. A supplier can give you payment terms. A properly managed promotional financing arrangement can temporarily reduce the cost of capital. The mechanism is always similar. Control capital cheaply, put it to productive use, and capture the difference. Now move to real estate. Suppose you find a property selling for $500,000. You put down $100,000 and borrow the remaining $400,000. Then you invest another $50,000 improving the property. Your total personal cash invested is now $150,000. After the renovation, imagine the property is worth $700,000. If the numbers, lending terms, costs, and cash flow all work, refinancing could allow you to replace the original mortgage with a larger loan based on the property's new value. At 80% of $700,000, the new loan would be $560,000. After paying off the original $400,000 mortgage, there could be $160,000 remaining before considering transaction costs and other expenses. The important idea isn't simply that you made money. It's that you potentially recovered your original capital while continuing to own the underlying asset. That is why experienced investors focus so heavily on capital recycling. But there is a major warning here. A refinance does not magically create wealth. The new loan is larger. The interest expense is larger. Closing costs can be substantial. And if the property's rent cannot comfortably cover the new expenses, the strategy can turn against you. The difficult part isn't borrowing. The difficult part is finding an asset whose economics still work after every cost is included. Now let's move to a strategy that gets much more attention because of how wealthy investors use it. It is commonly summarized as buy, borrow, die. The first step is buy. A wealthy individual may own assets such as stocks, businesses, or real estate that appreciate significantly over time. But an increase in the value of an asset doesn't necessarily create an immediate income tax bill. In many cases, the tax event occurs when the asset is sold. So instead of selling appreciated assets, an investor may choose to borrow against them. For example, someone with a large investment portfolio may be able to obtain a securities-backed line of credit. The portfolio becomes collateral, and the investor receives borrowed cash without necessarily selling the underlying investments. That distinction is critical. Selling can create a taxable gain. Borrowing generally creates debt rather than a taxable sale. But don't misunderstand the strategy. Borrowing isn't free. There is an interest cost, and the investment still has to perform well enough to justify that cost. More importantly, the collateral can fall. If the market drops substantially, the lender may require additional collateral or take other actions allowed under the agreement. That brings us to the dangerous side of leverage. Leverage magnifies outcomes in both directions. If your investment earns more than your borrowing costs, leverage can increase the return on your own capital. But if the investment falls while the debt remains, leverage magnifies the damage. And that is why borrowing against investments is not something to treat casually. There is an even more extreme form of leverage: short selling. When you buy a stock normally, the maximum loss is generally the amount invested if the stock falls to zero. Short selling reverses the trade. You borrow shares, sell them, and hope to repurchase them later at a lower price. If the price rises instead, your losses can continue increasing. There is no simple upper limit to how high a stock can climb. That is why leverage can be so dangerous. The same mathematics that can accelerate wealth can accelerate losses. Now let's bring this back down to something much more familiar. Consider a promotional 0% balance transfer offer. Suppose you have expensive credit card debt, charging a very high interest rate, and qualify for an offer that charges no interest for a promotional period, although a transfer fee may apply. The goal isn't to spend more money. The goal is to replace expensive debt with cheaper debt while aggressively paying down the balance before the promotional period ends. If you pay a relatively small upfront fee to eliminate a much larger interest expense, you've improved your financial spread. This is the smaller, more practical version of the same principle. Reduce the cost of borrowed money, then use the savings to strengthen your financial position. But remember, promotional offers have conditions, expiration dates, and potential penalties. The strategy only works if you understand the terms and actually pay the balance down. And this leads to perhaps the most accessible version of the entire concept. Your borrowing cost matters. A better credit profile can potentially give you access to better lending terms. That doesn't mean you should borrow more simply because you qualify for cheaper money. It means that when you genuinely need financing, reducing the cost of that financing can make a significant difference over time. Think about a mortgage. Even a relatively small difference in interest rate can translate into a substantial difference in total interest over many years. The same principle applies to business financing, auto loans, and other forms of credit. So instead of obsessing only over how much you can earn, pay attention to what your money costs you. Now, let's bring everything together. The calculation is simple. Start with what the borrowed money earns. Subtract what the borrowed money costs. That gives you the spread. Then consider how much borrowed capital you are controlling relative to your own capital. That is where leverage enters the picture. And this is the key distinction. Debt used to purchase something that loses value while charging you high interest can destroy wealth. Debt used to finance productive assets at a sustainable cost can potentially accelerate wealth creation. The debt itself isn't automatically good or bad. The economics surrounding it determine the outcome. So look at your own financial life. What does each dollar you borrow cost you? What does that dollar produce? Are you paying 20% to finance something that gives you little or nothing in return? Or are you using reasonably priced capital to acquire something productive that generates more than the financing cost? That's the number you should understand. Because the wealthy don't have a completely different mathematical universe. They use the same basic arithmetic. Borrow, deploy, compare the return with the cost, measure the spread, control risk, and make sure the numbers remain in their favor. The difference is that they tend to focus much more carefully on what borrowed money is doing after it leaves the lender's account. So remember this, debt is rented money. The question isn't simply whether you have debt. The question is whether the money you're renting is producing enough value to justify its rent. Get that relationship right, and debt can become a tool. Get it wrong, and leverage can become a trap. Same money, same mathematics, very different outcomes. And now, you know the number you need to calculate before deciding whether borrowing is helping you build wealth or quietly destroying it.